bedroom. Good afternoon to you all. Welcome to the great debate. Now, before we get going and get into the crux of the arguments today, just want to do some quick introductions to our combatants. So we'd like to introduce Adam Lawrence, and I'm going to give that opportunity to Andrew. Andrew, please introduce your opponent and Adam Lawrence.
Well, thank you very much. Well, what can I say about Adam? He's a prolific investor, and there's not many strategies I don't think Adam hasn't done. He bloodied my nose last week in the ring, commercial versus residential, but I will say I was very impressed at how quickly we managed to actually get the swingometer to say 15% of the audience went from wanting to invest in residential to wanting to invest in commercial. So I had the win on the swingometer, but Adam had the win last week on the overall percentages still investing in resi. So I've got a phenomenal adversary. He said we're going to sex it up. So I've come in my sexy shirt. What more can I say? So I'm looking forward to this one, Adam. Thank you.
That's great.
Thank you, Andrew.
And so Andrew referred to the poll, which gave him a moral victory, even though he was beaten by the audience. So we've started our entry poll already. So those of you who are joining us on Zoom can join in, and we can see that people are starting to vote already. So I'll refer back to that. But first, we need to know who Andrew Roberts is. Who's this person up in space wearing a funny shirt? Adam.
That was clever, wasn't it, getting Andrew to introduce me first, because it meant he had to be nice to me. Whereas now I could absolutely take the opportunity to be terrible. But of course I won't. So a more than worthy adversary. What can I say about Andrew? Runs a great independent meet over in Rugby in Warwickshire, so very accessible for most of the country really to get there. And he's run some great meets for a number of years over there at the Dunchurch Hotel. So I've attended a few times, and I always recommend it to people. Never swayed by anybody really. Puts a lot of stuff out there. Really good breadth of people that go along, and he's had some fantastic speakers over there. It does sound like I'm angling for a slot, Andrew, doesn't it? Really. It
sounds to me like I've got my next speaker lined up for a live event.
But very much enjoyed sparring last week, as it was, as Rupert and Andrew said, with the honours shared. Realistically, I felt I did have a much easier task last week, so I'm sure it'll be another ding dong slobber knocker today, knockdown drag out affair, and maybe if I win this one, maybe Andrew will be somewhere in the Milky Way on his next background. But yeah, Andrew, alongside running a great independent meet, is also a prolific investor, not only limited to property but also businesses as well. Trained accountant, skillful adversary with numbers and words. So always dangerous debating against such individuals. So respect to you, Mr. Roberts, and go easy on me like you did last week, please.
Okay, well that's great, and that was a little kinder than I was expecting, stroke hoping for. But let's hope that the sparks might start flying as we get into the meat of the things. But it does seem, Adam, it does seem that you've been given the easy pass for the second time round, because the entry poll is putting you at 77% at the moment. That means 77% of our Zoom audience today wants to engage in buy to hold activity at the end of CV19, and only 21% are interested in flipping. So we're going to close that poll shortly, and we'll keep that in mind for when we do the exit polls at the end of the debate. With that in mind, I think that it would be only fair that, Adam, you kick off with your argument and your opening statements, and then Andrew can follow up following that. So, Adam, over to you.
Thank you very much, Rupert, and thanks for officiating again. So it's a relatively simple one, I think, this realistically. It's an extremely difficult environment to be flipping in. There's a famous saying, you don't try and catch the falling knife. And I think that's probably what you're doing if you're buying property to flip right now, or arguably this year. Historically, the market lags a little bit behind a lot of other markets and indicators that move much more quickly, like the stock market. We've seen developments, very interesting developments in the last 24 hours with the price of oil, particularly West Texas. So it does seem like there are other things on the horizon, as we've alluded to before, regarding how this recession is going to play out and whether it will indeed be a recession, which by any technical terms it certainly will be, whether it will be a depression, whether it will be a deleveraging, whether it will be all of those things. Those are not environments in which it is ideal to hold property. So the beauty, it's ideal to flip property, sorry. So the beauty of holding means that you've got that great benefactor. Even deals that I've done over the years that have been suboptimal, it's fair to say, have been protected, cushioned, and helped out a lot by time, the great healer. And of course, when you're flipping, one thing that is your enemy normally is time, because you're trying to get a good return over a short space of time. And I think one of those things you've got to ask yourself at the moment is, with much thinner margins, with acquisition costs, with potentially bigger, stronger costs of or less availability of bridging finance, cash is expensive at the moment and not ideal to deploy necessarily. Do you really want to be holding on to properties that you're then trying to flip out to a market you don't know what it looks like? Would you buy today to sell in September, November, January, March? What's the point in time at which you look like you're going to want to sell to? And what does your end buyer look like? Normally, you would say there's a lot of safety in the flight to quality. But at the moment, could you honestly be buying top-end properties hoping that their values are going to hold up? Perhaps not. If they've had very good capital growth over recent years, they may well wobble. What we saw in 2008 to 10 was an 18-month decline in the price of properties. So fair bit came off overnight, but it kept on being relatively subdued for some time. And in some areas, the market stayed flat for 4 or 5 years. It would pretty much be a disaster if you're holding on to a flip for that sort of length of time. Whereas with a hold, what do you need to do? You need to stay liquid. You need to be in the game. You need to be good at tenant selection or good at agent selection if you're using an agent to manage the property. You need to buy well. You need to get the works done well. But ultimately, then you can sit back and reap the rewards over time. And then I'm going to borrow something that Andrew used as a bit of a stick to beat me with last week, and bring in the T word, taxation, because holding on to property, especially if you're using a limited company, is extremely efficient. There's a decent amount of your average refurbishment that can normally be legitimately written down as replacement cost rather than improvement. So that's going to be expensed against future rents. And normally you can, if you buy well and you add value well, you can end up with an asset that's worth considerably more than you've put in, but you don't, until you sell that property or that company, you don't crystallize that gain, you don't pay that tax. And so you can quite often be in a situation where if you've bought really well, if you sell the property, pay the corporation tax and then draw it out the company, you've got as much left as you would have if you simply refinanced the property and didn't have to pay any tax at all until further down the line. And if you're very clever with your structures and all the rest of it, you can end up not realising too much gain on that at all, just on the capital gain on the shares in the company. So there's a lot of reasons at the moment to hold on. Certainty has got to be one of them. Providing any sort of income at this time, yield is more important than it's ever been. Cash in the now is more important than it's ever been. And risk profiles have gone down, if anything. So that on top of the favourable taxation position, there are another 100 things I could say, but I've got to give Andrew a bit of a chance. So let's move over. Let's go back to space, back from the bedroom to space.
Brilliant, great opener there, Adam. Thank you very much, and I'm sure the questions will start to come in from the audience. If you do want to ask any questions, then please pop them in the chat box, or the group chat box there. Those of you who are on Zoom will be watching all three of us for the remainder of the session, because for some reason the YouTube feed doesn't show Adam when he's talking alone, so I've got to show us all in order to see Adam in the picture there. So I'm just warning Andrew that when you're not talking, or Adam, when you're not talking, you're still online, you're still in public view as far as that's concerned. And perhaps that would be good to see the expressions on your face when you hear your opponents say things. So anyway, what we're going to do now is we're going to go over to Andrew. Andrew is going to give us his opening remarks, and then we're going to allow Adam to make comments on Andrew's and vice versa.
Well, thank you very much. I mean, it was a great introduction into why you should consider holding. But I mean, I'm going to throw the taxation one straight back at Adam there, because the way I look at it is, I started with tax last time, so I'll start with the tax this time. Yeah, you've got regular tax returns and regular tax bills to do if you're buying to hold, but taxation, okay. Why flip trade, buy to sell, or whatever terminology you want to use for it? Yeah, we've got capital gains to pay if you're buying in your own name and it's not being done as a trade. Again, if you're doing it as a trade and you're a sole trader or a partnership, then you only pay income tax on the profits. So you're leveraging down unless you're a higher rate taxpayer. What about if you made it your own home? There's no capital gains tax at that point, or income tax, because that is tax-free. And if you did it in a company, as Rupert quite rightly said, for buying to hold, if you do it in a company, well, we get that, and you get 9 months tax window to pay, and you only pay corporation tax at 19%. So I think that's a good start why flipping, trading, buying to sell works. Now, stamp duty, that's a cost to buy to hold. Whereas you can use creative strategies to pay zero stamp duty on buy to sell. Now, how can you do that? Well, you can have an assignable option agreement. And sometimes that's called an assisted sale agreement. So you can use that method to pay no stamp duty. If you make it your own home, there's no additional 3% stamp duty anyway. So, I mean, that's looking at the taxation side of things. But let me just think about the next points that we've got. Start with the exit in mind. If you're buying to hold, what's your exit? At some point, you will go out in a wooden box, or you're going to pass this on as an inheritance, or if it's neither of those two, it's a trade sale. So you need to start with the end in mind, your exit. With buy to sell, that's quite easy. You need to be looking for a ready market of buyers, your location, the type of property that you're buying, the timing in the market cycle. I mean, Adam picked up on market cycles, and yeah, it is something for certain cycles, but not all. And stay mainstream. With flipping property, there's a damn sight less regulation. I haven't got 182 pieces of regulation to comply with. I don't have to deal with tenants. They're gripes. They're non-payment. Again, property is all about potentially getting rich. Well, you can get rich fast, or you can get rich slow. What do you want to do? I'd rather get rich fast. £100 a month over a year on a typical single let. Cool, I'm not going to get rich fast, am I? It's an active strategy, yeah. Those who know me well know that I'm not a passive person. I don't like to sit around and basically wait for the money to come in. I like to be active and doing things. That's why I'm here now with you, sharing my passion and why I'm active. And if you don't have a project to sell, yeah, okay, your cash flow's a bit negative, cash is going out until you have a project and you sell it. But if you want to quit your day job, the fastest way to quit your day job is to actually be trading property, because you can make your year's salary in 1 or 2 flips. You can't do that with a buy-to-let. You need quite a raft of them. So if you want to quit the day job, flipping is the way, but I caveat that with market cycle. Now, depending on where we sit in the cycle, it might not be a great strategy. And flips are great if you want to do buy-to-hold for building up deposits for properties. So, key advantages to me are I don't get rich slow at £100 a month. I can make £20,000 plus per single trade. I work once and I do the property up. I get it to a pristine condition. It looks sexy, just like my shirt. And then when it's sexy, I sell it. And I don't have a tenant trashing it. I don't have to do anything and I get paid. Now, how can I flip or trade property doing nothing and getting paid without having to do refurbs? Well, you could find properties, and if I use auction as an example, it could be being sold in the wrong auction. You could have a residential property in a commercial auction or vice versa. And taking that property into the right marketplace, you can get an uplift. So that's one thing. A trick which I've got a friend that does this, and it's really clever. He actually trashes a property that he's acquired, boards up the windows. He uses a spray marker that you use to do yellow lines on the roads with, and he sprays on the floor where a stud wall would go or where he's going to put a conservatory, and then he'll chuck it in auction. And believe it or not, he actually sells it for more than he buys it for. So what a great way of doing nothing and making profit. Everybody talks about financial freedom, living the dream. Well, I can have a period of activity where I am sitting there and I'm making myself busy. And then I can have a long holiday on the big lump of cash flow that I've just built up. You also don't have to be actually trading the property, flipping it, because deal sourcing is a method of flipping property, and it delivers on your financial freedom dream. Now, it's also helpful if the market is headed north, because if the market is headed north, you get a market uplift, and that double bubbles you the money that you make on it. Let me give you a few more examples of where I can uplift the value of a property without doing any physical building work, because who wants to have, politely speaking, and I appreciate there's probably ladies on, hairy-ass builders on their hands and knees with a bum hanging out around your site all day? Well, what about we look for a building where it's got a short lease and extending that lease and then trading it out for a profit? What about it's got a title defect? So what we do is we resolve the legal issues there. There could be a neighbour dispute, so they're prepared to sell the property cheap, and then you just remarket it and you've solved the issue. So what about properties which are out of area? They could be being sold and you deal with those. There could be a matrimonial going on. All you do is you take the property off the matrimonial, and because there's no debate or argument, you can move that one on quite quickly and easily. They could have other debts, so they're prepared to sell to you at a discount because they need to clear off, say, a credit card debt. It could be a probate sale and they just want it to go through fast to pay the IHT bill, the inheritance tax bill. Or they could be sourcing it for a buyer. So all of those are ways that you can easily make money on flipping, buy to sell, trading property without having to do too much work. And you can earn the cash and get it in your bank today, not in 20 years' time when you're in your wooden box and you can't enjoy it. So that's my case as to why flipping or property trading, buy to sell, is a winner. Rupert, over to you.
Some great ideas from outer space there, Andrew. And I think along there somehow, I thought we heard the clangers in the background, but maybe not. Maybe that was just me.
I think somebody unmuted themselves. I could hear somebody as well.
Adam, what do you say to that?
Well, I've got a few things to say. No wonder Andrew's out in space so that HMRC can't get him if he's talking about CGT on flipping properties for a start. But hey, I was going to go easy on him, but I've changed my mind on the back of that, really. Andrew's expanded his remit so broadly, well beyond flipping properties there. I think lots of that stuff there is great stuff about sourcing cheap properties, but there's no reason not to hold on to those properties because the cheaper they are, the bigger the tax bill they create. So I'm afraid I'm going to have to pull him up on everything he said beyond doing stuff up to sell to people, which at the moment he pretty much admitted is very difficult because he doesn't know who his buyers are going to be. This ready market of buyers for any flip property just is not out there at the moment, which makes it very tough for him, I know. I think I'd comment on tenant selection being a big factor in terms of some of these problems that he seems to refer to regarding people trashing properties. You've essentially got the same issue with contractors you might fall out with, but they can often drive forklift trucks and bulldozers into properties from what I've seen. So I think you probably need to be. And I do note, Mr. Roberts, your failure to really mention contractors too much at any point because they are good contractor management is such a difficult part of any refurb. But I can't let the legislation point go unchallenged here because I think we need to remind ourselves that CDM Regs 2015 could and should really be applied to any development of property that you're doing, and the liability, certainly in the HSE's eyes for sites like that, is much higher than the, yes, somewhat onerous, but ultimately relatively easy to navigate tenant legislation that's out there. I'd also say, quite a lot of these deals that Andrew was talking about, you could quite easily have your money out of those deals within 1 or 2 years. So I don't think you've got to wait for a long time before you get rich. It certainly gives you the ability to use somebody else's money to build a nice buy and hold portfolio. And if you're paying them interest, then at least you can take that off the tax bill as well. What else would I say? I think some good points around the PPR. If you've got a home, it's a brilliant and supremely tax efficient way to do it. The issue is, of course, we can only have one of those at a time. So it does make it a bit of a hobby rather than something that can be done at scale. Yes, I did take the point around crystallize when you do crystallize gains, but ultimately, I think the bigger your portfolio goes as a buy to hold investor, the more attractive it becomes to people who are interested in buying income streams. So at size, that becomes pension funds, that becomes other insurance investment vehicles that may well be willing to pay you above the market value, rather than when you're flipping and trying to move money quickly, you may well have to leave something, a fair amount on the table for the next person, especially when you're trading. So it's a chance to get all of the gain and then some, realistically. And I think if you, it comes down to, would you rather maybe nick 10 or 20 grand if the market is going with you, or would you rather take £300 a month for life and a payoff of more like 75 to 100 grand at some point in the near future? I'm definitely on the latter side of that without a shadow of a doubt. And I think, I couldn't argue with any of the points around things like short leases, stuff like that, very valid. But as I say, I think, you can get creative and clever with your contracts, your Section 42s and all the rest of it, and still bring stuff into the book to hold rather than sell. Although I do appreciate some of the stamp duty points, which I do think were. I'll finish with a positive. I do think the stamp duty points were relevant because there are some good stamp situations available to property trading companies. So that one I will concede. But thank you, Mr. Roberts.
Yeah, brilliant, great response there. And Andrew's got the opportunity to, perhaps a little bit more thinking time, the opportunity to respond to Adam's opening address as well now. And there was a hint on the fact that it was a trading business, and I think that with our current COVID-19 support packages, you know, that might be something that could be used and expanded upon with the argument. The difference between investment income and trading income. But anyway, I'll leave that to the combatants. So, Andrew, what have you got to say?
Yeah, well, I take on board Adam's point, and as I did caveat my talk, it is property cycle specific. It doesn't work in a downward sliding market. It's a brave man that attempts to buck the trend in a downward sliding market. So, you know, it is one of those things, but you do have a plan B if you need one, which is to actually fall back into Adam's model and then sell out at a later point. But I'd sort of challenge Adam a little bit on his CDM regs. If you're running a site, it applies no matter what site you are running. So it applies equally to both parties there. And I'd sort of look at things like long-term management. I mean, how many times do I meet people who've been in the game 20 plus years and they've become bitter and frustrated and had enough at how their tenants have just basically made them battle weary and worn them down. And I feel sorry that people have to be so worn down by their tenants. Yeah, you can put it to a managing agent, but what does the agent do when there's a problem? Adam, there's a problem with the property and the tenant. They're not paying all of this. So it lands back on your doorstep, even if you do outsource it to an agent. Property upkeep, it's a continual, you say in the long term you'll get 75 grand if you sell it, whereas I might get 20 now. Well, number one, you're relying on inflation. And inflation erodes the value of that 75 grand that sounds sweet in 25 years' time, but you're also negating the ongoing maintenance, the repetitive costs that you're shoving into that property. And the other thing I observe, and I mean this most politely to everybody out there, who hasn't been in a property that's been long-term let, and a landlord will go, oh, this is worth 100 grand because the property next door is worth 100. You look at the property next door and you look at the landlord's one, and it's had repeated long-term underinvestment in it, under-management, and it's in a poor condition. And they're deluding themselves. They've got to dip their hand in the pocket and effectively do a major refurb to get it up to the standard of the one next door. So I would challenge that. And the thing that probably sends a shiver down every landlord's spine is voids and non-payment. Section 8 and Section 21 at the moment, suspended. You've got legislation that is all against landlords who hold, and voids. If you've got a void at this moment in time, you might as well be flipping the property because you're going to sit there with a void for a good period of time because of social distancing. So I think there's a number of points there that I'd pick Adam up on. And I think he made a lot of very relevant points. And buy to hold is and can be a good strategy. And yes, you can refinance out, and I'll give you that. But as he did allude to, you do have to wait a year or two before you can get your money back out. Now, I can get the money quicker than that if I pick the right properties with the right problems and I can target the market correctly. So I can have cash coming in my pocket, albeit the property cycles. And I won't sort of mention that I'm doing a talk with David Clouter tomorrow on property cycles. No plug, Rupert. But
see how you did that by not mentioning it. That was very clever.
Yeah. If you want to find out exactly where we are now and exactly what's coming next, we'll share that. So,
Brilliant.
Rupert.
Thanks so much. That was a really good response there, and some really interesting stuff coming out. You know, I'm having this sort of mind of the developer in the pub, you know, saying, oh, being a landlord, that involves tenants, doesn't it? Not done that for 20 years, never will do, you know. But of course, everybody has their own opinion and their own viewpoint. So we got some questions here. Joy Cox, thanks, Joy. This is a good question, very relevant to the today. What do the speakers think will happen to property valuations pre and post vaccine? There's a school of thought that a strategy now could be liquidate as soon as possible. I suspect that means with current buy to hold properties, if that's possible, with a view to buying low en masse maybe later. So, Adam, what do you say to that?
It's a great question. I would say I think probably the ship sailed on even considering doing that at the moment, really, because the speed at which things have happened here is so breakneck that ultimately liquidation ASAP is going to mean auction realistically at the moment, or the dreaded wholesale below market value trader, both of which are going to involve a 20 to 25% haircut, potentially on best guess of today's values, which could mean they're sort of 30, 35% below where you think they are on your balance sheet. And Andrew correctly said a lot of landlords have an unrealistic expectation that their stock that they refurbed within the last 12 years still stacks up compared to next door who had an owner occupier property. I see that day in, day out, so I completely get that. So you're unlikely to find, I think, Joy, that would work only in a situation where you were absolutely convinced there was going to be a 30 to 40% drop in the market. And that would take a hell of a turn of events, I think, even more than what we've seen during this crisis, because ultimately people's properties have been protected, whether they be rentals or PPRs, by the furlough scheme, generally speaking, by the mortgage payment holidays in those areas of the country where the furlough scheme, frankly, doesn't do enough for the average wage. The people likely to be in trouble at the moment, I think, if are more likely to be the people at the top end of the spectrum. So the values that get hit may well be at that end rather than the investment grade end. There's still a demand, definitely a demand for investment properties. I've seen lots of deals in the last couple of weeks where they've still been snapped up very quickly, and I've been willing to pay much less than normal, but people are still buying them. So more power to those people. Maybe they know something that I don't. I'm very pleased to sort of sit on the sidelines a little bit at the moment, but trying to enter into a transaction right now, unless you've got you can evidence a tidy, strong portfolio which generates income and has been generating that income for the last few years, that sort of thing could still be attractive at this time. I grant that, but I think it's going to be difficult for anybody who wants valuations. It's going to be a bit of a lottery, realistically. So I think you'd be looking at a really big drop to want to liquidate and then get back involved. And as Andrew also said, the frictional costs of buying and selling property are, 5 to 7% of the value quite often. So you've got to put all of that on the table at both ends of the transaction. There's got to be a lot there for you to want to dump your portfolio and then get back involved. It's not as easy to sell as a gold or a stock or a share, which is why ultimately it can produce better returns, because it is less liquid and it is more hassle to get involved in it, realistically. So good idea, but I think probably the mechanics of it, the logistics of it, probably make it a non-starter, I'm afraid.
Thanks for that, Adam. And Andrew, there's other comments here, and one from Daniel Cheatham here, and the comments seem to be coming in more about values, and it's I think that they're attacking your argument a little bit, Andrew, but I would actually think that given that this debate is about what do we do in terms of acquisition following COVID-19, surely the argument goes both ways, Andrew. Whether or not you're buying to hold or whether you're buying to flip, then dropping values will affect both parties. What do you say to that, Andrew? I mean, surely in any market, the idea of doing a flip or buying to sell means that you're going to be looking for below market value opportunities and value enhancement opportunities in any market.
Yeah, well, point I would bring up at this point, because that's a great question there from Daniel, is although prices might be falling, what you have to look at is portfolio stress testing if you are going to buy and you're using finance. And it's not just on the property you're buying that the valuation is done. They will stress test your whole portfolio. And if market prices have fallen 10%, they will take 10% off all of those, which then makes the portfolio stress test harder to pass. So I would raise that as a real point to consider. If you're trading property, you've only generally got the one, you're not covered by portfolio mortgages, you might have 2 or 3 on the go, but you're not going to be stress tested in the same way. In terms of funding and where prices are likely to go, my gut feel is prices are going to fall, and they're probably going to fall around 20% to 25%. And that's evident a couple of reasons. You have a look at lenders. Virgin have said they're not doing anything on a greater than 50% loan to value. Most lenders are stuck at 60. There's an odd few at 65%. Now, they always factor in a market movement. And because there's uncertainty, they're factoring in a fall. Now, I actually do think that any fall will only be quite short-lived. And the reason it will be short-lived is there's going to be a lot of stimulus coming into the economy. We have seen this government pump in around about £1 trillion, 350 billion just on one day with one set of initiatives. But there's been around about £1 trillion gone into the economy. They are going to kickstart this with even more initiatives. And for people who are trading property, for example, there's going to be relaxation on planning rules. That relaxation on planning rules, being able to add 2 extra stories to buildings, being able to do more development in your back garden or convert things in a more relaxed environment, that's going to favour me opposed to Adam. The values will upswing because the stimuli that the government are going to chuck into the market and to the economy are going to cause us to upswing. Now, there might be a subsequent bounce down the stream, because one of the things that we don't want is irresponsible lending from the lenders. So what the Bank of England will be doing is monitoring the cash outflows, and they'll be monitoring the Basel funding formula, which is the loan to value, the risk appetite, the product portfolio that the banks are lending on. And that will keep a check on it, whereas in 2008, when it was just too late to do anything, I think will stop us going into a deep dip following anything now or in the future. So that's my justification and my reasoning and my thought process on where we are in the market and what we're going to have. And hopefully that answers Daniel's question.
Yeah, that's great.
Rupert,
we've got one coming in here from Akhil.
Rupert, could I just add a little bit to what Andrew said there, because I think I hopefully can add a little bit of value. One of the things is I think it's really important to make the distinction between values and prices right now, because prices ultimately are what properties transact at, whereas a lot of what Andrew was talking about was values. So I could see the reasoning behind why he says prices might fall 20 to 25%, but I would argue that that probably reflects values. And I think if and when we look back at the land registry for over the next 12, 18 months, when we're looking back in 2 or 3 years' time, I don't think you'll see that sort of drop on properties that are actually transacted. I think you'll see a drop in the number of transactions because people know there's this uncertainty around the sort of values metric. And I think the more possibly relevant forecast is a sort of 60 to 80% drop in transactions now, rather than worrying too much about price versus value. But ultimately, you have got to know your end user and your end buyer. And the other thing that I would add is I'm currently on new applications still putting through 75% loans to value mortgages as a portfolio landlord. on rates between 3.6 and 3.8%, with Aldermore have been doing that for the last few weeks. They're still happily lending at that level. So there has been a pullback in lending, but bear in mind there was 80 and 85% available. A lot have come down sensibly to 75. A lot of the smaller packager style lenders like the foundations and the fleet, they are running scared at 60% LTV, but I don't think that is reflective of what it looks like in the long run. I think that's reflective of HSBC or Citibank or whoever sits behind them saying, hang on a second, we don't want to borrow this risk. We want skin in the game. We'll do 60%. And if you think about how the stress test is actually put together by the PRA, the stress test that was tweaked a few years ago, they're really looking at rent coverage. So until we've seen evidence of rents going down, which could happen in a deep recession, there's no two ways about it, because affordability goes down, it doesn't give you a problem with servicing debt. And a lot of these individual mortgages that almost all the assembled company, including myself, tend to use on holding properties these days, don't have loan to value covenants. So they can't call in the debt. So it doesn't cause you a massive issue, depending on where you are, how long you fix your mortgages for, and with the usual caveats, of course. But for me, it's not causing a big worry, because there's no need to crystallise, there's no want to crystallise. The income is still coming in, even if there are the odd payment plan having to go into place. The income's still coming in, it's still more than covering the mortgage, and there's that element of security there. So just
a really interesting point there, Adam. And this point about value and market contraction in the is very specific to the property market, is that the market contraction is a much greater factor than the value drop in a downward market in property. And so yeah, really interesting point, and three-dimensional thinking needed there. Adam, I have a question for you, and it's regarding people actually trying to get hold of buy-to-let properties in the future. And it does regard lending. And obviously, lending is going to be slightly more difficult for some people. The loans to values might come down, the valuations might come down. So we might find that it's a little bit more difficult to acquire with the same amount of cash to acquire the buy-to-let portfolio in the future as it has been in the past. Whereby on the flip side of the argument, bridging lending has always been a little bit easier to obtain. Okay, more expensive, but that gets built into the figures. But with the buy to sell, with the bridging lending scenario, you do have the second exit, of course, which is a temporary hold. So if you were having to then service that debt after you'd finished a project, you can actually put a tenant in to service that debt for a period of time. So there is, potentially more entry opportunity and a second exit with buy to sell going forward. What do you say to that?
Well, I think it all depends on, it comes back to an extent, it comes back to intent, doesn't it? And whether that's part of your plan. As Andrew said, if you're doing sort of one at a time and you're one that's on the go, then ties up all your cash, you've got a bit of a difficulty. And it depends what sort of bridge you're on as well, I suppose, because if you're on one that's going to go on to default rates, you'll probably be quite keen for that not to happen. If you're on one where there's just a rollover penalty in terms of interest and you can have another 12 months, you may well be happy enough to suck up the rollover penalty and take it out of your margin, and do something about a length of tenancy. But it's quite risky having tenants in on bridges that you then want to sell, because then go back to Andrew's point, what if, because you're a flipper and you're not a holder, you're not very skilled at managing the agents and the tenants and the tenant selection, and you put a bad tenant in who then you can't get out, who even trashes your beautiful new flip. So I think you need to be a little bit careful blending those two strategies, depending on the sort of scale of firepower you've got realistically. I think when I look at buy to hold, I look at my number one exit from a bridge would be the term financing that I can obtain, and this is one of the ultimate tests of recent years. Whenever I've gone in and used any bridging, I've always been carefully watching the credit markets and the availability of credit, because I'm my own exit. So I know what I need to do. I need to stay financially healthy, robust, give lenders confidence, keep on top of my figures, make sure everything's presented correctly, and come up with coherent arguments as to why they should keep lending me money. If then other exits can, my secondary exit could include sale, either via auction through a yield sale. That's what I tend to be reasonably good yielding stuff. So it will sell at a price at an auction for someone who wants a turnkey investment. So I've probably just got the flip side of that strategy, but can probably, the thing about flipping houses, generally speaking, is you do them up to such a good standard in order to make an impression on the market that you can't really auction them, because that stuff doesn't sell very well at all at auction. Whereas if I do it to a good but fair buy-to-let standard, put a tenant in, get a reasonable rate of return, I can then sell that as a turnkey investment to the auction room. So I'd say it's probably more, and of course with the auction I've got the 28-day certainty in terms of completion. If you can't use the auction mechanism, or it would cost you all of your margin and then some to use the auction mechanism, you've probably got a problem there. But that's more of I see that more as a ripcord. You raised some interesting points about bridging as well, Rupert, which I think has changed seriously, materially since the great financial crash. And we've probably seen 3 or 4 years of really booming bridging, where we've been able to get 90%, even 100% of purchase price funding from bridgers to buy discounted stock at reasonably, really fair wholesale low rates, really, to be honest. So I've taken a big slug of advantage of that. And of course, they're worried at the moment because where's my exit? But my exits can be at 60, 65% if needs be. What will that mean? I may need to leave a few grand behind in a few properties, absolutely, but nothing that the sort of rate of return that I leave those few grand behind at is in the 20s, 30s, 40s% a year. So I can always supplement that by borrowing, or just take that out of cash, knowing that I'm getting a decent cash on cash return. So reasonably well protected, but this situation has thrown different curveball that we've not seen before. Will the bridging market come back to where it was? I think would probably be a good follow-on to your question. And I think the answer is probably not very quickly. The bridges have used it as a bit of a reset to say, hold on, rates were getting really low. We were taking more risk than maybe we thought we were. They want to try and reset this and bring it back to the old rates. But ultimately, they're going to be sitting on big sums of money, non-utilisation clauses in agreements they've got signed with banks and private equity houses, and they're going to need to get that money out of the door. So I have a very different attitude at the moment to a property I've got to put 40% cash into and take a 60% bridge versus what I would put 10% cash into, just because I think that cash needs to work really hard right now. And I know a lot of trade, whether you're trading in the same way that Andrew referred to, or whether you're buying to hold, because I tend to buy like a trader, really. It's just that my exit is me. That's why I agreed with so many of Andrew's points about sourcing properties. But I think ultimately, does that option look as attractive if you've got to put in 3 or 4 times the amount of cash at this time? I don't think it does. So the bridges will be, they've been fast, they've been agile, they've been running scared a little bit during this whole debacle. When will that settle down? I don't know, but I expect they will want the bridges, like the auction market, to be functioning normally, because that provides them with a lot of their business. And at the moment, the auction market is all up in the air. Some of that just due to the logistical problems with viewings and valuations and all the rest of it. So it's difficult to know where they'll come back to, but I think we'll get back to sort of 80% relatively quickly, getting back to the 90s for the likes of me. They're going to push back against that for a while, I think. But at the moment, it just means you've got to do exceptional deals if you want to buy anything. And I'm quite happy with that, because I think it's a good protection at the moment to have to force yourself into an exceptional deal in order to get your money out of your pocket.
Brilliant, thank you. Thank you for that. Andrew,
I agree with what Adam said there.
It says, is the new norm going to be seeking lending up to 60% to safeguard against future pandemics or recessions? So are we going to see a new norm of 60%, Andrew?
My answer to that would be no. And it goes back to understanding why it's at 60%. And it's at 60% for several reasons. Number one, the government have announced that homeowners and landlords are eligible to have payment holidays, or the correct terminology in my book is payment deferrals with a roll-up of interest on that loan. Now, the bank doesn't have a department that deals with payment deferrals on a normal day-to-day basis. It's an exceptional situation. So they've either got to find and go to Reed or other recruitment agencies, hundreds of staff to train up to sit on a call centre, or they redeploy existing staff. So what they've done is they've redeployed existing staff who were in the new business teams to actually deal with the inbound phone calls that are there, or to process the electronic inquiries and the paperwork they need to do at their end. So how does a bank suddenly free up that new business team? Well, the first thing they do is they disincentivize their customers or prospective new customers from coming and asking for new business. And if you're coming in and you're able to meet a 60% loan to value, then you're the type of customer they want anyway, and you'd probably ask for 60% outside of a pandemic. So that's one reason why it's 60% loan to values, is resource from the bank's point of view. The other reason is there is a huge amount of uncertainty, and the banks, because of government regulation and RIC instructing surveyors not to physically go out to properties, but any valuations they do them on a desktop, then what they need to do is work out how they're going to value. Now, if valuations are only coming in on desktops, how accurate is that valuation? Therefore, by jacking down the loan to values, because they haven't got a man, boots on the ground, going in that property, valuing it, then they can pull the rug quite quickly and change the loan to value to reflect that. So it's down to the fact that they anticipate values falling a little bit because there's market uncertainty, and that always happens with market uncertainty. Because people's incomes are affected that are going to be buying these properties, if you've been furloughed and you're on 80% of your money, yeah, okay, you're not going out to the cinema, you're not spending at the theatre, you're not spending on meals out in restaurants or takeaways and so forth because you're furloughed. So you're actually saving money. So the 80% probably you could survive on without any impact. But the reality is you might be eating into your savings. And if you're eating into your savings because you're self-employed for the next 3 months, you might have to defer any property purchases. Now, if you're deferring your property purchases, that takes buyers out of the market. If buyers are coming out of the market, that goes back to what Adam said earlier, there's less transactions happening. If there's less transactions, prices start to fall because the buyers that are in the market can dictate the price. So that's what I would say.
That's great. Now, time is moving on to the hour mark, and so we're going to wrap this up shortly. But before we do, there's a couple of things we need. We need some closing remarks from our combatants, and we also need to throw up a couple more polls to find out who's going to win. I think we can encompass this question in the closing remarks, but quite an interesting point from Michael Roberts that is suggesting we might be being a little bit investor-centric, coming back to this point about contraction, and I think he's challenging perhaps the 20 to 25% reduction in values that was stated earlier, that basically, will they really go down because the majority of owner-occupiers aren't going to be selling below market value? They're simply going to be holding onto their properties and sticking at that point. And his other point that he introduces, which is one that's it's speculative, but reasonably likely, is that we're going to get a little bit more government support, perhaps in the form of a stamp duty break or something like that, which could counter some downturn in values. Anyway, those are the points made by Michael. So let's go to Adam for his final comments, and then to Andrew.
Brilliant. Yeah, I thought that was a great comment from Michael. And take his point is there is 90+% of the transactions that go on are in the retail market, no two ways about it. I think, Michael, what you probably need to remember there is ultimately there's a different level at different parts of the country which people can sustain as and when values fall, as we were talking about. So if you live month to month, like a lot of people do, Andrew made the point about being on 80% of your income, but of course that only works up to 2.5K. So I think you could be seeing people in higher end properties. If you're on PAYE and you normally get 5, 6, 7,000 pounds a month, and your mortgage is 3 grand, 4 grand, whatever, you're in some trouble at the moment. You're taking a payment deferral, as Andrew correctly says. But in certain parts of the country, people can't wait as much as they would want to. There's going to be 1-2 million people unemployed, maybe more, on the back of this. I don't think there's any real doubt about that. We've already seen that number registering for universal credit, maybe more. So a sudden step change in lots of unemployed people overnight. People will need to liquidate properties that they live in. There's no two ways about it. So those are the kind of things that will transact. The people who've got money, the people who've got savings, the people who've got secured jobs, yes, they will absolutely be able to hold on, and that's why the values and the prices will diverge a bit. So I don't think we will. I'm pretty convinced we're correct about transactions falling, and what does transact will be motivated stock, I think, realistically. But just to round up, I'd like to say it's been an absolute pleasure. Been some brilliant questions today. Very much enjoyed debating with Andrew. I think we should give Andrew the easy topic next time, because I'm almost starting to feel guilty, Rupert. I did say almost, not really. But no, really, really interesting points. And Andrew raised a lot of stuff there that I do really agree with, to be honest. So hopefully everyone's voted by now, so I can say that. But thanks for comments and tuning in.
Brilliant. Well, thank you for that. And as you've been speaking, we've had the persuasion poll go up, which is shifting a little bit. So you're both on 50%. 50% of the voters have said that they have been persuaded towards Adam's argument. That means they entered the debate on a flip strategy and have gone the other way, and the 50% have gone towards Andrew. So how about that? We're going to leave that running until Andrew's finished his speech, and then we're going to go for the final votes, which is who's won the debate. So Andrew, please, your closing remarks.
Yeah, well, I applaud Adam, because there was a little bit of audience persuasion on there, telling the audience that he thinks they've given him some good questions. The audience did give good questions. Don't patronise them, Adam, please. Don't patronise them. No, I mean, a great debate again, an awesome combatant, and I've actually thoroughly enjoyed this, and I hope the audience have enjoyed it as well. Now, from my point of view, I invest, I trade, I'm in commercial, I've got some residential, I do a bit of everything, and I'm a bit like Adam. And Adam came up with some phenomenal points. But where I'm coming from with this is, if you're after lump sums of cash, you need to trade. And it's okay refinancing and taking the money that was yours anyway that you've put in and taking it back out. That leaves you level pegging and getting £100 a month. I mean, Adam says he doesn't mind leaving a couple of thousand in at 20%. I worked out, and that's 40 quid a month. Woo! I'm getting a 40 quid a month on my money. That's not particularly exciting. So what I would do is sit there and go, trading is all about changing your lifestyle. If you want to change your lifestyle, then this is the way to make those changes, and make those changes quickly. I said it in my talk, get rich slow. That's what you do when you're investing. And if you get rich slow, you're not going to change your lifestyle anytime quick. And look at how many landlords, even Adam admitted it himself, how many landlords do we know who've been in the trenches 20 plus years, and they are so battle-hardened, bitter people. There are people who aren't, but there's a large number who are, and they've pretty much had enough of getting beaten by the government, getting beaten by tenants, getting beaten by the system, having lenders get on them if they've got finance. It's getting tougher and tougher for the landlords. There's some great exits for landlords, and there's some great returns there as well over the long run. But it is a long run game. And to me, I'd rather have cash in my bank now, because I can spend it now, and now is when I'm living. I might get hit by the number 9 bus tomorrow. I hope I don't, but I'd rather have the money in my pocket now than in 25 years' time when I can't enjoy it because my body's given up and I'm too old and too decrepit to enjoy it.
Brilliant,
So
brilliant. And
that's my closing remark.
ending that is, Andrew. Fantastic. And you want the money in your bank, the bank that you've bought and that you're flipping. So
absolutely.
So I've just launched the final poll, and as I do, I'm just going to spend a minute to wrap things up by giving you a taster, an exclusive. You're the first to hear it on what we're planning for a week today. We do, as you can see, try to vary what can be a little bit mundane, these continual webinars that are going on Zoom, and we're trying to keep them a little bit upbeat, keep them a little bit more entertaining than just a straight webinar. But next week we're going out a little bit further on a limb. We are going for pure entertainment, and we have both Adam and Andrew rejoining us on the panel. But we also have 2 property people who are also professional comedians who are going to join us as well. So we have Raymond Akhtar, who is currently in Saudi Arabia, and we have Linda Wright from Manchester of Planet Wright, who has a very, very serious job as a planning consultant. But you know, her in the evening she puts on her raconteurs persona. So we're looking forward to that as well. And we're going to do a format which probably most people will be familiar with, which is a property version of Would I Lie to You? So our panelists and our contestants and combatants are going to be offering us with some lies and truths and questioning each other, and you'll be able to question them too from the chat box in order to determine whether or not some of these bizarre stories that they're going to tell you about their property life, about their property history and journey are actually true or outright lies. So we thought we'd enjoy that. An hour at 4 p.m. next Tuesday. So really looking forward to that. And look what's going on here. We're absolutely neck and neck. Is anybody going to pitch in now to actually give us a winner? Or are we going to leave it at that, at a dead heat? Wow.
Sets up round 3 very nicely. The dead heat.
Oh, no, sorry. No, I'm sorry, Andrew. I was just about to close it. And 2 people have come in, some late runners have come in there. We're going to give you the last chance. Going. Anybody else going to come to Andrew's support?
I was just furiously logging on a couple of my other accounts to vote for myself.
Wow. So, well, Adam just picked you to the post at the last run there, but a very, very close run debate. I certainly enjoyed it. I know that I can see that Adam and Andrew have enjoyed it immensely, and I hope you have too.
If I can just say a massive thank you to Adam. Yeah. If I can say a massive thank you to Adam, he's been a brilliant sport. He's been a brilliant sparring partner. And I know Adam and I have already got some great truths and lies lined up for what's coming next week. So I know what's coming. It's going to be so much fun. You are really going to enjoy this. And the other panelists are going to be fantastic as well. Back to you, Rupert and Adam.
Oh, thanks, Andrew. Really appreciate that. I'm not sure I'm cut out for the Would I Lie to You format because I just tend to laugh too much when I'm lying. So there's a huge tell there for next week. Bit of a spoiler alert, but no, absolutely the same.
It's starting already.
Same back to Andrew for being a brilliant sport today, and Rupert for putting it all together and skillfully keeping his hand on the tiller as well. So lots of fun. Hopefully some good stuff in there as well. So enjoyed it a lot, Andrew. Thanks a lot.
Thanks to everyone for tuning in, both on Zoom and on Facebook. And see you very soon, if not next week at next Tuesday at 4 p.m.